So thank you very much for investing your time with us on this Saturday and on this online mega webinar hosted by PMS AIF World platform, which provide research-backed quality investing services with an endeavor and promise for long-term wealth creation and prosperity. So we have kept this session on the most hot topic, that is the 20 trillion India COVID package from the perspective of investors and macroeconomic outlook. To introduce, my name is Rakesh Rathod and I lead the institutional sales at Purnartha Investment Advisors. And I'm the moderator for the last panel of the day. And as they say, desserts are always served the last. And here we as a panel will try to be that much needed dessert in the scorching heat of the May after the wonderful sessions we had since morning. So today we have an amazing panel, which I call Money Win, literally. So as a panel, understanding the 20 trillion Indian package, and why I call them Money Win, because Lakshmi as in it's the goddess of money and Ajay as in the winner. So that is what I coined the name for the panel today, where we will be talking about the big trends we need to keep our eyes on that could directly impact your business and investments. So to introduce formally Ms. Lakshmi, who loves finance, films, food in that order, and is a renowned CIO fixed income at Kotak Asset Management company, managing fixed incomes, funds offshore and onshore both. And Ajay, who is the CEO, PL, Prabhudas Lilladher Portfolio Management Company with over 2.5 decade experience in portfolio management and research in Indian equity market. I think both come with years of experience in their respective asset classes, and we are all here to benefit from their wisdom. So guys, I think this sounds good, right, Kamal? Am I audible?
Yes, absolutely. Yeah, you're audible.
Yeah. Great. So today we will try to understand the way forward for the markets and economy by especially understanding the few intricate and important items from both the asset classes perspective. And so who better than to talk on money literally? Lakshmi, let me start with you. Okay. So on the face of it, 20 trillion is a very huge number, certainly much more than anybody expected. But post FM announcements, it doesn't seem to have cheered the markets, Lakshmi. How come such a meaningful number get ignored? And what are the facts about these announcements? What is it that you see really meaningful in it?
Yeah, thanks, Rakesh. So firstly, I seriously have objections when people compare apple and custard apple, because both have apple in it, so therefore they say that both have same nutrients. So the fact of the matter is both have very different nutrients. I think something similar is being done to the package that has been announced by the FinMin. People are saying that, it is Khoda Pahad, Nikli Chuya, those kind of statements are being passed at. The reason why this kind of statements are being made is because there is a comparison being made to what India has announced vis-a-vis what the rest of the world has announced. And obviously leading the pack is countries like US, Japan, and certain countries in the Eurozone. I think one needs to be mindful of the fact that every country has its own dynamics. And therefore, when you look at the announcements, you see there has been focus on the employment generating sector, which is typically the MSME kind of segments. There is focus on the NBFC segment where there has been already problems in the last couple of years. And apart from that, there has been various announcements both for the agri sector, rural India, as well as the urban India. So I would say that in the context of a country like India, given our own limitations, if you look at India's tax to GDP ratio, we are among the lowest in the world. So it's good to spend, but I always say it is important to be mindful while spending. I think that is something which India has been able to announce so far. Will you have results overnight? Obviously not. You can't, put in a seed in the soil and put water every day. In school projects, we used to do that, We used to put this moong and you expect it to sprout. That would take 3 days to sprout. And here we are talking about a huge dent being made by a virus, which is obviously grappling with the entire world is grappling. If you break up this entire stimulus, there is a fiscal stimulus, there is a monetary stimulus. And I think a combination of that So we saw first monetary measures coming in, then we saw the ministry announce certain fiscal measures. And again, yesterday we have seen some announcements on the monetary front we have seen. So I think it's a combination. It is an orchestra which has to work. Markets, two sets of markets, bond markets clearly did not take this negatively. The fiscal, slippage has not been that very dramatic because the monetary stimulus or the additional part is not that very negative. Equity markets, the markets are already run ahead in terms of expectations were building up. So once obviously the cat is out of the bag, it is natural that some froth gets given up. So I don't think markets have reacted so negatively. There has been general cheer. Certain sectors have done better. So for example, we saw huge, at least on the fixed income side, we saw huge cost of borrowing actually come down for the NBFC segment, specifically the very short end. So I think there are positives. As I said, don't compare apples and custard apples.
Sure. Very, very well, Lakshmi. And that takes me to Ajay. From that perspective, Ajay. So Ajay, we have worked together in the past and always admired your views on macros worldwide in general and India in particular. What's in your view are those macro parameters linked that affect the markets, and what should investors ought to focus on from a medium term perspective, obviously from equity asset class as a whole?
I think, Rakesh, for any economy, there are three prime movers or three engines of growth that one needs to focus on. And the percentage of contribution from each three differs with each economy. In the Indian context, I think it is the domestic consumption, which is the big daddy, contributing nearly 60% of our total GDP, followed by investments and net exports, roughly equally divided. Now, if you look at the situation in the aftermath of the unprecedented situation created by COVID, we are seeing that all three, for different reasons, are sputtering. If you look at domestic consumption, then I think the aggregate demand has gotten very badly mauled because of the confinement that all of us have to endure, albeit for the health reasons. The debate between lives and livelihood is gaining salience across the world, and in Indian context in particular, I think the gathering storms because of the impact of the migrant crisis, the job cuts that we are seeing being affected across various sectors, as well as the cut in salaries that many industries are announcing, is getting compounded by certain sectors which already were stressed in the aftermath of, say, the demonetisation or the rollout of the GST. In particular sectors like MSMEs, which contribute a lot to the total employment. Now, the COVID crisis only has pushed them. They were already on the edge of precipice, and their problems have gotten worse. If you look at the banking sector, again, the Damocles sword of massive spike in NPAs is what is worrying the economy. And from a high of around 8 to 9% of increasing GDP, the worst case scenario of doubling of those NPAs, and in particular, I think after having endured a very bad corporate spike in NPAs in the corporate sector, we already are seeing a fear about the unsecured loans or the personal loans, the retail loans, I think coming under a scanner, and an expectation of a spike there over the next couple of years. If you look at the other second contributor, which is the investments, I think if we divide it between the domestic investments, so that there is government investments and private investments, I think the government investments, as the previous speakers have very elaborately explained, I think the fiscal constraints, the buildup of off-balance sheet liabilities, clearly would ensure that in the first tenure of Mr. Modi, one saw a tremendous focus on roads and roads, railways, and power distribution as the key focus areas, with roughly 1 lakh crores of capital investments going into those roads and railways every year on a trot for 4 or 5 years. But now the worry is that will the government be able to roll out a large pump priming? The answer clearly seems to be difficult to fathom. because of the concerns on the fiscal side. And on the private capex, I think even prior to COVID, I think the animal spirits were moribund. They were almost dead. And the COVID crisis and the resultant lowering of the demand and hence opening up of more sort of space in terms of lesser capacity utilization will push back, I think, the recovery in private capex, in my opinion, for a couple of years more. One point there again was a reasonably successful IBC also had ensured pre-COVID that many of these successful entrepreneurs were, instead of picking up greenfield capacities, were finding it easier to go and go in for a brownfield capacity. We saw Tata's in case of Bhushan Steel. We saw Birla's in case of Binani Cement. We saw JSW in case of Monnet Ispat and maybe possibly Bhushan Power, so on and so forth. So I think, and the lastly, net exports, which are again dependent on the global trade. And one clearly seeing a collapse of global trade as well as rising nationalism, I think leading to a possible near-shoring of activities which previously were being outsourced from on the other side of the world. So I think that's why one needs to be cognizant that all the three prime movers for the economy are sputtering, and it will take a Herculean effort on the part of the policymakers to look at specific packages to rev up these slowing engines of growth.
Sure. So I think, Ajay, you have really given us a detailed perspective, and that brings me back to Lakshmi. So Lakshmi, I do appreciate when you started the conversation when you said apples and custard apples. But again, now India being isolated, and we are part of this global village. So we are bound to compare with other countries when it comes to the stimulus package which has come up. And why has Indian market not welcomed it? Though you partly answered that, but would like to pick your brains in a much maybe a different perspective on how do you view it from the execution perspective as well.
See, every stimulus that gets announced has to follow up with some kind of additional money requirement. And that is the case for India, that's the case for US. And those who have the printing press, obviously, and those who command the world's currency reserve money status, obviously will have a competitive advantage because they can negotiate better terms with the rest of the globe. And therefore, the frontline country that comes to mind is the US. In 2019 itself, if you recall, the US, this was way before COVID, the US had actually done 3 insurance rate cuts. So that because there was a sagging feeling of the economy, and they didn't want to they wanted to ward off any recessionary tendencies. So it is therefore no surprise that it is the US federal government and the Federal Reserve, the central banker there, are working, feverishly to ensure that the stimulus is announced. So in fact, among the developed countries, apart from Japan, of course, US is clearly right there on top in terms of its percentage spends. And of course, they have embarked on a massive balance sheet expansion campaign. If I flip that equation again, as I said, to India, the resources are there, the intent is there is absolute keenness. But if you have limited resources, you have to divert those resources to the most needed sectors first. And I think that's exactly what the Indian authorities have done at this point in time. See, you have to be mindful. You are an emerging nation, and you also run the risk of external rating agencies. Everybody is waiting to offer you brickbats. Bouquets are very seldom available. And in these markets, again, both start with B. But look at the differentiated treatment. For every good thing that you do, you're welcomed by more brickbats. So I don't think that's the case with countries like US or for that matter, Japan or Belgium or any of these countries which have done that. If you compare the ratings wise of the countries, and if you see what India has done, we are pretty much there. I don't think there is any material deviation. Also, I think there has been an excellent tightrope walk that has been demonstrated by the authorities, where they have been see, center is spending extra, state is spending extra. Yesterday, if you see, there was an announcement made by the central banker saying that additional state requirements, the redemptions of these liabilities of the states, that will be funded from a consolidated state fund. So they are being mindful of what they are doing. So they are allowing, मतलब ढील भी छोड़ रहे हैं और इतना भी नहीं छोड़ रहे हैं कि हाथ से फिसल जाए. So they are, doing that tightrope walk, and therefore I say that some sections of markets would have buffered in additional or euphoric expectations, and that when obviously doesn't come across. See, if I want my son to score a perfect 10, and if he gets 9,
yeah,
of 10, I will say no, it's still half marks.
Right. I understand, Lakshmi. So great. So Ajay, I think moving from macros, let's get into the micros as well, because a lot of investors definitely would like to see how this entire policy thing fits into their portfolios. So in view of this unprecedented economic turbulence due to COVID-19 and the accompanying uncertainty, Ajay, how should one approach Indian equities? What are the headwinds and tailwinds from the investment perspective? If you can be very, very specific about those tailwinds, if you have something in mind on those lines.
I think, let's start with the agri sector. I think although that contributes only 15% to India's GDP, but nearly 50 to 55% of Indians are still dependent on agri and allied activity. And we've had sort of a bountiful harvest in case of Rabi, and sort of the IMD has predicted a near normal monsoon for the coming monsoon season. And plus, in the package that was announced by the government, I think what took many investors by surprise is, I think, the rollout of long-pending agri reforms, which have the potential to catalyze, I think, a growth in the agri sector over the medium to long term. Essentially, the scrapping of the Essential Commodities Act, or more important, or equally importantly, I think sort of the stranglehold of the agricultural produce marketing committees and allowing farmers to sell their produce anywhere in the country. So the farm to fork kind of policy that many corporates also were looking for, which can sort of eventually lead to corporatization of agriculture. I think, in my opinion, the bugle has been sounded by the Modi government. So that is one area sort of which that's why it's heartened, I think, investors who are looking at many agrochem companies and companies which cater to the farm ecosystem. So that's one area I think I would be looking to focus on. I think the other tailwind is clearly the plunge in global crude prices, both due to excess supply concerns because of geopolitical tensions between OPEC and Russia, the shale oil sort of complex playing its part, as well as sort of the caving in of the aggregate demand. And let's not forget that 85% of oil we import, and every dollar of oil fall leads to $1 billion of sort of savings in our import bill. And this in turn sort of has a cascading impact on a large number of macroeconomic parameters, with lower imported inflation, lower trade deficit, lower current account deficit, RBI breathing easy in terms of rupee being sort of everything else being equal, rupee being stable, and hence being able to continue with its accommodative monetary stance. Sort of so it all plays into that. So that's again a tailwind one must not lose sight of. The third is, we saw the RBI governor saying yesterday that they'll continue with an accommodative monetary stance for large time to come, and liquidity will be ample. Also, from a risk assets perspective, from emerging market perspective, nearly a third of the total global debt is today yielding negative returns, and with a massive sort of printing of money by the global central banks. In fact, an effective open-ended monetary policy announced by US Federal Reserve. I think once some semblance of normalcy returns with the reopening of various economies in Europe, in various states in America, as well as in the emerging world, one will start seeing at some point in time money gravitating to markets where there is growth, and India sort of can attract its own share. Rakesh, let's not forget that the MSCI, which has simply deferred the rebalancing of the index in the last quarter, has said and has held out hope that in the June quarter they will be looking at rebalancing because of the measures that the government had taken in the last budget. And there is and it's likely that roughly $1.7 billion of passive flows and up to $5 billion of active flows could come India shore come September. Today, in this gloom and doom, we tend to forget these tailwinds. Also, I think one more data point I would like to share with the viewers is that in December 13, I think vis-a-vis December 13, the holding that FIs had in Indian equities today is at the lowest level. We are today at 20% of FI holding in Indian stocks. The government holding is also at record low at 6.6%. The DII holding is at 14%, and so is retail holding at 14%. So who has increased the holding? It is the Indian promoters who basically have sensed that there is undervaluation in their franchises, and they are on a buying spree, and their holding has gone up by 2% in the last 6 to 9 months. That essentially is an indication about the undervaluation for the Indian stocks. So I think there are a whole host of tailwinds. I did touch upon the headwinds in the macro section, but let's not lose sight of that. And the valuations, I think that's again dependent on what kind of earnings growth can one pencil in for the next 2 years. I think because of the COVID uncertainty, many analysts are able to not look through, understandably, the kind of erosion that one can see in FY21 earnings. In fact, with just 10 days of disruption in activity in the last quarter, I think we were expecting in FY20 the earnings to grow by 2% prior to the COVID crisis for FY20. But now with the COVID-related provisioning being taken by many companies, we think we will have to lower those estimates for FY20, and FY20 could possibly see a 5 to 7% drop in earnings vis-a-vis, say, FY19. And FY21, I think, although it's extremely difficult crystal ball gazing, but I would not be surprised if there is a 15 to 20% drop in earnings in 21, with an expectation of a pickup in earnings in the second half. And a recovery in FY22 is again is what the market is today baking in. Valuations, we are at around 18 times 1 year trailing earnings. Last 10 years average is 19.2 times. 19.2 times 1 year forward earnings. We are today at at around say 18 times. But then as I said, the E part is something that people are not able to get a handle about. And hence, I think, I personally would be looking at markets with a cautious stance. At the same time, I'll be constructive.
Sure. Great, Ajay. I think that brings me to Lakshmi again on a similar note. So, Lakshmi, we have a lot of, I think, awareness about equity when it comes to the earning estimates and price multiples and all that. But I think that very little is being talked about debt market, though it's a huge multiple of equity markets worldwide. And that is where I think we have this opportunity to talk to you on behalf of all the investors. That's basically all the stimulus and fiscal and the other things happening around. What does this imply for debt investors, Lakshmi? So that would be really great insight for all the investors who are looking to invest in debt, because we keep on talking a lot about equity and it's pretty straightforward, and debt is not so well understood. And I think this could be a great opportunity for all of us to have that flavor from you.
Sure. Firstly, debt is actually like the Cinderella in the fairy tale, where it has always been the underdog till you had some very other carriage. That is where the news is again usually not fair. Equity and fixed income as an asset class, and very recently people have been making those comparisons. I always say that equities is the Red Bull. It has a lot of caffeine to give you energy boosters on your portfolio, where debt is poor Nimbu Pani, where Nimbu Pani you can have it in all seasons. It just acts as a refresher to your overall portfolio. And therefore, I believe that in this kind of a market scenario where there is general consensus that growth is not going to come back in a meaningful hurry, and across segments, there have been sectors which have been severely impacted from an earnings standpoint. So if there is no E, where will the P come? You can't keep relentlessly chasing the P. Here is where that fits in terms of a solution. Again, I'm not suggesting that you need to substitute equities with fixed income, but it's high time that the way you are focusing on your health and personal fitness, you have to focus on your portfolio fitness. And I tell investors that, irrespective of what genre or what religion or what caste that you belong to, there has to be a thali system that you need to follow. And fixed income is part of that wholesome thali. In today's interest rate scenario, today's market scenario, given the kind of consumption demand that has been broken, check out your credit card bills, my credit card bills. Where is the fuel? Where is the apparel? Where is the PBRs? Where is the popcorn? Nothing of that is there. In fact, you're getting grocery bills, you're getting dairy product bills, and you're getting just more of food bills. That's about it, and veggies and fruits. Discretionary spendings are down and how. And that would mean that inflation is not going to be a big concern, at least for the foreseeable future. Yes, we need to worry about the monster called inflation because world central bankers are pumping in steroids into the system. That will get inflationary at a later date. But why worry about the monster when there is nothing monstrous at this juncture? That coupled with the fact that the bond markets require vitamin M. So we require ABCD for our body, but the financial markets require vitamin M or vitamin money. And there is loads of vitamin M which is sloshing in the system. North of 7 lakh crores of banking system liquidity, A, B, rate cuts after rate cuts. So how many more? So in fact, the note I wrote out to investors yesterday, I said it's already raining in summer. And what I mean by that is investors therefore have to be conscious that fixed income offers you a plethora of options. So if you tell me, you know what, I'm a one-day investor, you have a fixed income strategy for you. You come and tell me you're a 10-year investor or a 10-day investor, you have fixed income solutions to you. So this is literally like an all-seasons footwear where you can use it in summers, winters, rains, all of those seasons. And this macro environment, according to me, is one of the most conducive periods to actually own fixed income. But you need to understand your appetite. I keep telling this to investors, please do not come fixed income with a 3-year investment horizon and look at your NAVs after 3 days. It's not going to work that way because you do not treat real estate like that. You do not treat today, if you're living in your house and if you actually compute the NAV, you will actually get into depression. Nobody does that. 2 years back or 1.5 years back, if you would have looked at the value of your gold treasury bills, I don't know which antidepressant would have cured that feeling of yours. So, everything looks good when we are getting too much of information on the fingertips. So I believe that in this kind of a market scenario, you cannot ignore fixed income as an asset class. Be conscious of what you're choosing. If you go to a Gujju Thali restaurant, he will serve you 3 sweet dishes. But if your appetite or your health cannot suit even one, then stay away from it. That doesn't mean you can't consume the entire thali.
So I think, Lakshmi, nobody tells a story around a debt like you have done. And I really thank you for that, for making it so simple for all of us to understand that overall asset perspective. And I think we are coming towards the end. And Ajay, just on a conclusion, I just wanted to know which are the sectors, if you can just throw up, say 2 or 3 sectors, though we have been hearing since morning, couple of sectors like telecom, pharma. But according to you, which are the sectors that will benefit and which ones warrant caution? That is very, very important in today's context. I think this could be a great time to restructure our portfolios when everything has fallen. It's time to come out of those stocks or those sectors which may not perform in future, and we may maybe shift into the sectors which may perform. So in today's context, what would be the contours of portfolio construct, and which sectors should one be looking at and which one warrant cautious?
I think broadly, I think we could look at sectors in 3 buckets. I think the green, amber, and red. Now, insofar as portfolio construct is concerned, does it mean that the sectors which fall in the red should be completely avoided? In my opinion, I think you need to have a judicious capital allocation graded across the 3 buckets. But at the same time, one cannot afford not to have an exposure, say, in an important sector, even if it is facing a temporary headwind. Now, insofar as sectors which sort of are should be looked at favorably, I think the previous speakers have alluded to a few of them. I think telecom comes to mind, where one clearly has seen emergence of a near duopoly, pricing power coming back. In fact, ARPUs expected to go up by at least 15 to 20%, if not more, on an annual basis for the next few years, as well as a possible floor price being accepted by the regulator, providing a downside risk to the key players in the sector, as well as attraction of large amounts of FII investments that one is seeing in the digital platforms that are being created by the two preeminent players in the sector. So I think telecom should be looked at favorably. Secondly, I spoke about agrochemical companies. I think, with the supply chains in China looking to diversify and MNCs looking to mitigate their risks in terms of diversifying their sources of, in addition to healthcare and pharma companies, specialty chemical companies and agrochemical companies also come to mind. Healthcare, I think, is a sector which I think just 3 years back, I think in the institutional portfolios were just 4%, were 8%, had come down to 4% as far back as just 3 to 4 months back. And in a jiffy, in a matter of 2 months again, today I think the institutional investors in India collectively hold around 8%. And that essentially has been because of structural reasons in terms of the US pricing for generic companies, which was coming off quite sharply because of consolidation of vendors. I think, that has abated, as well as the approvals process has quickened from the US FDA, and the domestic market also is holding up quite well for these companies. And there's a safe haven status that that this sector enjoys. I think FMCG companies, solid balance sheets, trading at very high valuations, but we have seen that I think in these times of uncertainty, I think many of these companies have withstood, I think to a large extent, I think the shocks that have laid low many other sectors. So I think these 4 sectors, telecom, consumer sector, consumer staples in particular, healthcare, and specialty chemicals and agrochem are the ones that are the favored sectors. Now, if you look at the amber sectors, I think I would say the gas companies, the IGLs and the MGLs of the world, and the Gujarat Gas of the world, I think which will be seeing immediate restoration of demand after the economy starts opening up. I think with more and more caps coming and starting to fly, or and plus they have monopolies in their areas, are the ones that one should be looking at favorably. I think the IT sector, again, strong balance sheets, a good conversion of cash, the companies do, as well as although the discretionary IT spend, I think could possibly come under cloud because of the problems that their clients in America and Europe are facing. The run of the operations that would keep their businesses running, I think are and the dependency on the Indian vendors will ensure that the Indian IT services will continue to chug along at a good clip. I think 2 sectors I would like to focus on, which are domestic cyclical, which were not so favored, but progressively I think investors should be looking at both of them and look at increasing allocation. The first being auto sector, I think which after ILFS crisis and the dependence of many auto companies, auto companies on the financing from the NBFCs had taken a hit, as well as there were issues in terms of transition from BS4 to BS6, concomitant increase in costs. But I think the market already, in my opinion, has discounted most of these negatives, and with the cyclic and with opening up of the economy, I think you will start seeing value being attributed and emerging in certain pockets of the auto sector. So I think there again, in my opinion, the move away from public transportation or shared mobility into personal transportation, I think can benefit companies in the two-wheeler space, in the passenger vehicle space. We already are seeing the tractor manufacturers opening up almost fully, and both the operations as well as the front end, and indicating a strong surge in demand because of a strong Rabi crop. So I think tractor manufacturers could be looked at. One section of the auto sector which will be last to recover and which has tremendous problems and headwinds is the commercial vehicle sector. So I think auto one should look at favorably. The second domestic cyclical is cement sector. I think consolidation already happened in the sector. Pricing discipline is extremely strong in the sector. The cost containment measures that the companies have unveiled are very strong. And hence, I think although the demand, I think will take time to come back, although the utilization levels are quite strong from the companies that have just announced their results. I think cement sector is one that one should be looking at favorably and looking to increase allocation. In the BFSI sector, which falls in the red bucket, we have already discussed about BFSI being a proxy to the economic growth. If the underlying economy is going to degrow by 5% to 7%, this estimates for the GDP growth for current financial year. Obviously, you'll see the BFSI sector, especially the lending institution, getting impacted in terms of the sharp spike in the asset bad low and not non-performing assets. Plus, the higher multiples being attributed to them were embedded in the large growth that one was seeing, especially in retail-focused banks and in case of NBFCs. Now, that sort of part of the equation has come off, and hence we have seen this sharp pummeling that these companies have seen in the last couple of months. But here again, I think whether the non-lending institutions, insurance companies, should they be looked at? I think they should be looked at, in my opinion, favorably, as well as sort of some of the gold financing companies. I think construction is one sector one needs to be very careful about. And when I say construction encompasses also infrastructure sector, engineering and capital goods, because we did discuss in my reply to first question about how the government fist being tight. I think pump priming will be difficult, and the private capex also is moribund. So I think this part of the economy will be, in my opinion, last to recover, and hence one needs to exercise tremendous caution in case of the capital goods companies. Real estate also again had its own problems pre-COVID. They are only accentuated post-COVID. So that's part of the market one needs to be exercise caution. The global cyclicals, I think metals and mining, I think unless the global trade, which is sort of in a state of funk right now, picks up and the global economy sort of come back to some sense of normalcy, I think it will be difficult for one to be bullish in case of the global cyclicals, and one needs to exercise caution. And lastly, I think sectors which are a direct line of fire, namely aviation, restaurants, hotels, multiplexes, I think, and has seen 60 to 70% erosion in their prices from the peak. I think as the opening trade, the economy starts opening up, there will be these die-hard enthusiasts who will start nibbling at some of the leading names in these sectors, because they might feel that the discounting has already happened in terms of the worst case scenario. But here again, one needs to be cautious, because it is a second wave and a further sort of necessity on the part of policymakers to slow down the operations in these vulnerable sectors. I think one is open for again a sharp downfall sort of in these companies. Sure. So that overall sums up my view about the favored sectors, the sectors you need to be cautious on, and the sectors which are amber sectors, where sort of I feel that you need to look at increasing allocation.
Sure. Thanks, Ajay. And so, Lakshmi, just to pick up things where Ajay left. So when I want to invest in a debt, so typically I think all the companies in the red section of Ajay would be eligible and would be looking out for money in the market, right? Typically the green ones will not require money. They will be like very rich, cash rich, balance sheet and all that. So from a debt investor perspective, how you would like to play that? Because the company which requires money maybe the red bucket of Ajay, and the company who doesn't require money is in green. So how one as an investor balance that out to still lend that money and be part of this fixed income as an asset class?
So by and large, Rakesh, the sensitive sectors or the red, amber, green kind of sectors which Ajay mentioned kind of will play out even for fixed income. Just one small differential here is that a sector which may not do well because of growth prospects being bleak also will come under a negative sector category for equity because there is no growth prospects. But that does not mean that the solvency of the company is bad. Therefore, in this kind of a market for a fixed income investor, like for example, look at NBFCs. NBFCs are a pariah right now for pretty much everybody and anybody on the street, specifically for the equity guy, because there is no growth, right? Forever, since the IL&FS happened, there's hardly any growth. But when I flip it to the fixed income side, there are still pockets of value which we will identify. So though it is not a green sector, but there are some green shoots in terms of certain stock picking that can be done on the fixed income side. Therefore, you're right, absolutely. The ones which are in the green, hardly any pharma company borrows today. Hardly anybody in the healthcare segment is borrowing. Oil gas is very selective. There are just some of the bellwethers who have the market to borrow working capital, etc. So yes, it is a tricky situation, no doubt. But by and large, equities tend to not ignore, high operating expenses, high, leverage, low cash flow kind of businesses. I think pretty much similar is for fixed income.
Sure. So I think great, Ajay and Lakshmi. I think we have come towards the end of this session, and let's close with this. What is that one thing, Ajay, you think you and everybody in this room should be thinking about that, but maybe not thinking right now? Maybe intuitively we should be thinking about that. What comes to your mind? And somebody or many of us are just ignoring.
All of us sort of are hopeful that the cautious opening up of the economies globally as well as in India, I think we will be able to go back to normalcy or near normalcy, sort of without any hitch. But I think the path is sort of full of sort of many concerns, and one needs always. That's why I said I am constructive on equities. At the same time, I'm also cautious on equity.
Sure. And Lakshmi, any concluding notes from your side on this question? What one should be not ignoring at the moment?
So again, I'll take the medical world in this particular case as analogy. You are mindful that there is virus all around you; it is invisible, but you are, not ignoring it. You are taking abundant precautions. Some of them are going to work, some of them are going to the grocery store, etc. So there is a fear, but there is mindfulness in terms of your action. So when it comes to your portfolio, also please have the same approach. Don't ignore any asset class just because of its past so-called not so glorious returns, etc. Treat it fearfully when you are selecting the portfolio, when you're selecting the portfolio manager, whether it's fixed income or equity. But having had that fear in mind, completely shying away or exiting is not the solution, which some of our friends are doing in the fixed income industry. So please be mindful of the virus, but trying to live with the virus is going to be the new normal. Leaving the virus is not an option that you are doing.
Sure. So thanks a lot, Ajay and Lakshmi. And before I conclude, let me conclude by thanking all our members of the panel and all the participants. I think we really had a great, excellent insights on the questions that were asked. So Kamal, any concluding remarks from your side?
Sure. So this is Sankalp.
End the session.
So this is Sankalp from the PMS AIF World
Sankalp
team. And thank you, Rakesh, for moderating. Thank you, Lakshmi ji. Thank you, Ajay ji, for being with us. Thank you to all the panelists that were there. And thank you to the very patient audience. Today we had some technical glitch, and thank you for being patient with us through that. I hope we've added some value to the table as investment advisors. You can know more about us at www.pmsaifworld.com. You can give us a shout. Always happy to help. Thank you, participants. Concluding, we hope that the virus ends soon, but it's still wishful thinking. But as investors, what we have to do, we have to do. Just because we are going through a pandemic doesn't mean that there is nothing to be done, as it was highlighted today. So I hope this session gives an insight on how the right thing can be taken up. Thank you, everybody. We hope to see more of you. We hope to see a lot of the participants again as we go through the month ahead, and as we come around the quarterly numbers. We are going to organize some more sessions, insightful sessions. Thank you, everybody.
Thank you, Ajay. Thank you, Lakshmi. Take care.
Thanks. Bye. See you.
Bye.